Also, this is just like a crazy thing to say.
To make a significant change.
I don't think that's the case at all. I mean, if we're talking about, when you start using a number like the GDP is enormous. So you can't really see the differences, right? I don't think that...
Saez-Zucman, who's written a lot about this, he did a study and he said...
The name drop. And I'll come out and say it, okay, I'm a libtard. Fuck them doctors and lawyers or whatever. I don't care if you're working still. If you're making a fuck ton of money, you gotta pay. We're redistributing a fuck ton of your money to all the brokies out there, okay?
One argument that you'll often hear is somebody will get very wonky and they'll say...
Very wonky.
The statistics show that if you raise...
We're bringing up statistics.
Capital gains rates above a certain amount, then you stop raising money because people stop selling their property. Something like that, right?
Bro. Sometimes people get very wonky. They bring up the statistics and they say the Laffer curve, like, bro.
So what I think we should do is say that whenever the person transfers the property, whether they transfer it by gift, whether they transfer it at death, whatever they do with it, once they no longer own it, then they should tally the gains and pay taxes on it then, so that the...
Holy lock-in effect, bro. Your enemy is never the fucking billionaires, guys. Your enemy is always the farmers. It's always the farmers. Look at the non-compliance rate for farmers, bro. The great Wi-Fi apocalypse of Nonfon's house, okay, has continued. So we're back with another pre-recorded video, but, you know, it's a semi-live reaction still. I have pre-watched the video we're going to talk about today, and I've written down a few notes. I'll link them down below because they have some studies in them and stuff, and some of them might be paywalled, but they are all accessible via slightly illegitimate means if you know where to go for that. And, you know, make sure to like and subscribe during these trying times. One last thing. Look at this fucking guy. Isn't he great? Don't even have to shock him to stay there, guys. Wonderful. Sadly, I'm covering him up, but give you a sense of what we're dealing with today.
Wealth inequality is reaching a breaking point in this country. The top 1% now command roughly a third of the nation's wealth. Meanwhile, the bottom half of Americans control only 3%, and 1 in 10 Americans still live below the federal poverty line.
Yeah, so we're dealing with this type of stuff. Not everything he said was wrong. We'll get more into the specifics of it in a second, but he's speaking to the tax lawyer girl who also appeared on Ezra Klein. I watched that video live on stream. I had a number of issues with it. I have many of the same issues here. But, you know, just two things that I think I want to, two concepts that I think are important. One is just kind of understanding it takes longer to either, not even necessarily debunk something, but just to explain the differing assumptions and the reasons behind different numbers, and then it does just assert it, right? You can just assert those things. And those two, the things he said there weren't necessarily wrong. There were much worse things to say later on. But, you know, it takes forever and ever to explain all the differing assumptions of all the different economists who write all the differing estimates on these things, right? And I also, the second related point to that, I think a lot of times all these like supercharged narratives or whatever where, oh my God, the rich are unbelievably rich and it's crazy how much the wealth has grown or whatever. Like a lot of this stuff, I think it's important to understand, just comes down to relatively mundane assumptions about, you know, how to measure, for example, healthcare income provided by employers, or how to measure other types of non-wage benefits, things of that nature. And, you know, these are just like totally mundane methodological debates that economists have. I will touch on the poverty point simply because they don't get back to that one later. Now, it is true if via like the official poverty metric and the supplemental poverty metric, the official poverty metric is at about 10%. Supplemental poverty is about 12%, I believe, right now. But I mean, it's just a nice overview from Iglesias. I'll have, like I said, all the stuff linked in the descriptions or whatever. For the official poverty metric's not the best metric to use just because it excludes the government benefits that include or that alleviate poverty to a substantial degree. And then the supplemental poverty measure, you know, is better than that. It includes those things. And you can see that actually has been dropping a lot more over time. But if you just use, rather than sort of a more like relative poverty metric, like the supplemental poverty measure, the official poverty measure, where they're essentially defining a given line of income that adjusts up over time as the sort of poverty line, right? It's just for inflation, to be clear. If you just kind of look at consumption poverty, which is just like kind of a fixed absolute level of consumption that in the past poor people had, right? People we consider in poverty, that has gone down quite a lot over time. So it's just a pretty famous paper related to that issue, the Myers-Sullivan paper. This is just a result from them. You can see the official poverty line has barely budged at all. Supplemental poverty, which is this after-tax money income is going to align relatively closely with supplemental poverty, but it isn't the supplemental poverty measure. Has gone down somewhat, but consumption poverty has gone down even more than those. And there's another paper finding roughly the same thing. This is their different measure of absolute poverty. So no huge disagreement with the other numbers he said there, but I think some of the implications are mistaken. 55 trillion is like a plausible number for the top 1%, and then like the bottom 50% number was like plausible too. I don't think either of those numbers were like insane or anything.
One instrument that might have created this divide is the tax code. There are a number of loopholes in the tax code that have enabled America's wealthiest to increase their wealth. And today, the average American is paying a higher tax rate than the wealthiest 400 people in the country. Meanwhile,
So see, that part is not true. So firstly, inequality is not, wealth inequality especially is probably not driven substantially by a tax system. So just broadly, like effective tax rates over time have not really substantially gone down. So this is even, Piketty, Saez-Zucman's work. You can find they just is not the case that has been. So the average effective rate has been decreasing even for the top 1% here, right? And then we can also, look at, this is just a correlation between the real interest rate and the top shares of wealth across the country. You can see there's a pretty strong correlation here. We're not going to get like super deep into this stuff specifically, but essentially a lot of the increase in wealth inequality has been actually driven by simply a decrease in the real interest rate, which sort of drives up the like equity value of companies, but doesn't actually make the future flow of consumption any higher. So like John Cochrane gives an example in an old post of his. Suppose Bob owns a company giving him an income of $100,000 per year. Bob also spends $100,000 per year. The discount rate is 10%, so his company is worth $1 million. The interest rate goes down to 1%. The stock market booms, and Bob's company is now worth $10 million. Hooray for Bob. But wait a minute. Bob still gets an income of $100,000 per year, and he still spends $100,000 per year. Absolutely nothing has changed for Bob. The value of his company is just what some call paper wealth. And why care about wealth at all? Let's compare Bob to Sally, who earns $100,000 per year in wages and has no assets. The distribution of income and of consumption between these two people is entirely flat. But the distribution of wealth was already concentrated before the interest rate dropped. Bob had $1 million because we ignored Sally's human wealth, the present value of her salary. After the interest rate declined, wealth inequality is 10 times larger because we also ignored the higher capitalized value of Sally's human wealth. But why should we care? Bob and Sally are both marching along unchanged. You might object that I assume Bob didn't change consumption. He should sell some stock and go on an around the world private jet tour. Or he should do what gazillionaires really do, start a foundation and give money away. In fairness, they don't do this nearly enough. We'll touch on charity more later on, by the way. But Bob won't do that for a simple reason. Originally, he wanted to spend $100,000 per year, and if he sells his company for $1 million and invested at 10%, he could spend $100,000 per year. Now, if he sells his company for $10 million, he can only invest it at 1% per year. So he can spend the most he can spend is still $100,000 per year. So that, I think, kind of gives the intuition pump there of how financial, like the paper wealth can change. But it doesn't necessarily mean the actual future flow of consumption changes if that, the driver of paper wealth is results from a decline in real interest rates. which is not always the case, but is largely the case. As you mentioned, this paper provides more than just, graphs that look like they correlate. It actually provides, actual math and tests or whatever, but that's no fun. That's no fun.
Audit rates, particularly of the ultra-wealthy, have collapsed to a historic low. And we spent some time discussing these issues on the show, but we wanted to bring...
So I didn't look too deep into this claim, but it doesn't seem like audit rates of the rich specifically have collapsed like a ton. So that's looking at the decrease in audit rates across like the income distribution. You can see from 2010 to 2019, it's been minus 61% for $1 to 25,000, 25,000 to 200,000, minus 76%. The biggest decrease was from 200K to 500K. Then from 87,000, from 500K to 5 million, it's 87%, 5 million or more, 86%. So like, it's kind of just, it's distorted a bit towards the, the wealthy, like above 200K. It really actually, well, they technically have the highest, but above 500K for sure, right? But like for the ultra wealthy specifically or anything, like it's not that unusual. And also, your enemy is never the fucking billionaires, guys. Your enemy is always the farmers. It's always the farmers. Look at the non-compliance rate for farmers, bro. A lot of tax non-compliance is actually distributed towards the lower end of the income distribution. Now, in fairness, a lot of the non-compliance rate for people towards the lower end of the income distribution is like, simply paying taxes late and having to pay whatever additional fees and such. Whereas, we might imagine that the sort of richer people are engaging in more schemy ways to try to avoid taxes, right? But they actually tend to, on their compliance rate, be pretty high. If we look at the second biggest thing here, and also worth mentioning, the tax gap, like how much money we actually lose from not enforcing this or whatever. Obviously, like for example, for farmers, it's really low because farmers, despite being really non-compliant, only make up like 3% of the U.S. economy, right? So the actual gap there is not very big versus like for corporate tax, you can see the gap there is quite big, even though, they, as a percentage, have a higher compliance rate. But another big issue is like proprietors, sole proprietors. There's a lot of avoidance issues there. And most people who have like sole proprietorships or whatever are like, they're not the type of rich people that they are discussing here, but they are disproportionately, I don't have data to back this up, but typically people towards the higher end of the income distribution, but not even millionaires necessarily.
Bring in someone who has dedicated their career to studying how the tax code shapes inequality and how the wealthiest Americans use it to preserve and to grow their wealth across generations. So this is our conversation with Ray Madoff, professor at Boston College Law School and author of The Second Estate, How the Tax Code Made an American Aristocracy. Ray, thank you so much for joining us on the show. I'd like to start with a potential rebuttal to your thesis, which in so many words is that the wealthy are not paying enough in taxes compared to the rest of us. And then we'll get into the conversation. But the rebuttal, the statistic that a lot of people use, is the fact that the top 1% of Americans pay 40% of the federal tax revenue in America. So if that is true, if the wealthiest are paying most of the taxes, then the first question is, what's the problem?
First of all, thank you so much for having me. I know that the two of particularly you have started with that question, because I call that the statistic that saves the rich from taxes. And we see it being published in lots of publications. Wall Street Journal, The Economist, The Washington Post has now joined in. And the
evil, all owned by billionaires. Coincidence?
And highly misleading. And so the way it's described as the top...
It's the, that true but misleading is a bit... Some of it's a bit ironic coming from her.
1% pay 40% of all income taxes. But what they're not saying there is, what do they mean by top 1%? What they're actually talking about is the top 1% of income earners, those with high taxable income, high paid lawyers, bankers, surgeons, anybody with a very high salary. And those people are indeed paying heavy taxes. And however, the problem is that this says nothing about our wealthiest Americans. And that is because our wealthiest Americans avoid income taxes by avoiding taxable income. And
so we'll get specifically to that point in a second. But I think it's, to some degree true. I think it is misleading a lot of times when people say, like all the top 1% or whatever are paying, all the fucking taxes. Everyone else is just leeching, okay, when we're doing the Mitt Romney memes or whatever. But I mean, it does seem to be true that just overall the taxes is very progressive. and we'll get more and more into this later on, but this is just from David Splinter's work, but it's not just David Splinter's work. I think his line is the blue one, I believe. No, that's someone else's. This is his is the red one. And this is both including and excluding payroll taxes, you can see, but broadly, him, even Saez-Zucman are on here, the CBO, the TPC, or PS might just be Piketty Saez might not, yeah. Zucman was not on that one. We did not get the Zucman math here, but they all largely agree overall. The sort of average tax rates and people in every quintile or decile here rather are progressive. I also I'll link this in the description. This is a thing I've been working on, but this is so it's like that same graph, but in a more interactive format. And on my sort of website, it's really just a GitHub page, or a bunch of GitHub pages. It has a bunch of different information about this. So this is, to be clear, made by, it's not all made by Claude Code. I downloaded the papers and the data sometimes myself. Sometimes it's able to find the replication package or Excel, Excel XS or whatever file for me, right? But this is just another, and it's pretty good about, I made sure it's pretty good about its sources. So it's, you can easily find the stuff you need or whatever. This is ITDPs, they're working this or whatever. They're looking at the total taxes paid by every sort of, they separate it by quartiles. And then I guess, or no, not quartiles. What's that? I actually don't know if you divide it by 5, what that is, because deciles is 10, quartile is 4, but they start out with each 20%, but then they add some extra ones here, whatever. But it seems to be largely progressive, and here the top 1% are paying only or 23% of total taxes, but that is a little bit higher than their total share of income, and this is including, I believe, all state taxes and stuff as well.
As a result, they are just as likely to be...
And state tax systems generally are probably not as progressive as the federal government's income tax system.
...in the 40% of Americans who pay no income taxes, as they are in the top 1% that pay 40% of income taxes.
So
I don't know what the basis for that is. Even the phrasing there is confusing. I had to listen to it 3 times to get it when I first watched this.
No income taxes, as they are in the top 1%. Result, they are just as likely to be in the 40% of Americans who pay no income taxes, as they are in the top 1% that pay 40% of income taxes.
The top 1% of people, according to her, are just as likely to be in the 40% of people who don't pay income. I don't know what she means by just as likely to be in, because I don't believe it is the case that the same rate, I couldn't find any evidence that it is the case that the same rate of the top 1% don't pay any income tax as the general population, right? Because that would seem to imply that 40% of the top 1% don't pay any income tax. I don't think there's anything to substantiate that.
So the statistic that we find quite fascinating here is that Americans pay an average effective tax rate of 30%, and then among the 400 wealthiest Americans, the average effective tax rate is 24%. And that goes back to what...
So they are, I believe, are just getting that from our favorite Saez-Zucman, okay? Because, here, all taxes paid relative to economic income of the top 400 averaged 24% in 2018 to 2020, compared with 30% for the full population and 45% for top labor income earners. Now, that average rate, it might not be totally off or whatever. David Splinter has his reply to it, and I think it makes good points. Actually, hold on, I have it red and highlighted and such. So they don't, there's a few kind of errors they're making corrected with the assumptions David Splinter makes. I shouldn't even say assumptions because some of them aren't simply assumptions, but the effective tax rate for all people falls to 25%. And for the les billionaires, it goes up to 38% from 24%. And also, they do end of end of life giving and such, and you can add that to it. I understand why people might be opposed to that. Okay, I don't necessarily defend adding that into this measure. He does obviously make it clear that it's taxing giving rates, but that's not what people typically care about. But just, kind of cliff notes here. Saez-Zucman do this a lot, where they kind of exclude a lot of refundable tax credits, a lot of in-kind benefits from the effective tax rate of lower income people. The amount they do it differs by papers, but I know in one of their papers they did it to such a degree that the bottom 10 or so percent of the income distribution they had just was paying more taxes than they actually made an income, which doesn't make any sense. Of course, in the real world, what's happening is they are paying taxes on some of the transfers they get. So this relates to one of their 2019 papers. Not counting transfers creates a big problem for Saez-Zucman. How are people paying taxes when they earn less than they pay in taxes? Of course, in reality, they pay taxes out of their transfer payments, but Saez-Zucman are ignoring transfer payments. So in the case of people who earn no income, they would be forced to divide any sales, excise, or property taxes paid by zero earned income, which is mathematically meaningless. Even with small positive amounts of income, Saez-Zucman computed tax rates would be unbelievably large. They solved this problem by excluding individuals who have earned less than $7,250. Incredible work here, incredible work. By dropping those who earning less than $7,250, they get an average tax rate that is consistent with the story at the bottom 60% of the income distribution, having relatively constant average tax rate of about 25%. Had they used an equally arbitrary cutoff of $3,625, they would have had to explain a nonsensical tax rate of about 50% for the lowest income in their sample. So, those types of issues are not uncommon with their work. Would you believe, even when I'm pre-recording stuff, okay, I still get distracted. I forgot to mention this paper, which again they mentioned a few times throughout the video. Other issues with it besides the not including transfers, the fact that they essentially double count capital gains in their income measure. Again, not something unique to this paper, because Saez-Zucman did it a lot. Adding capital gains represents double counting. If the value of a share increases because of the increased performance of the company concerned, the increase in its share will be related to increases in dividends expected in the coming years. To count both as income would be to count the same income flow in two periods. Therefore, it appears capital gains added by the people who wrote the paper, including Saez-Zucman, to national income results in double counting due to including current capital gains as well as the associated profits. Additionally, they don't essentially, when they rely on a Forbes 400 list, when they calculate tax avoidance, they don't account for the fact that Forbes 400 is like listing families as one unit or whatever, and they file taxes differently sometimes in separate returns. Missing wealth also results from BSYZ not correcting for Forbes dynastic families, using estimates from Smith, Zidwar, and Zidwick, Zidwick, however you pronounce it, 2023, who found the Forbes 400 list include about 2,370 adults. I adjust for this discrepancy. The baseline adjustments for dynastic family wealth tend to be being spread out over more than 400 tax returns, lowers top incomes and taxes, increasing the top effective rates by 8 percentage points. You can see, this is I should have pulled up this version of the graph earlier too. This better version of the graph's got even more estimates on here about how progressive our overall tax system is. And then the adding transfers, they make some mistakes with regards to SALT cap stuff and state level taxes. The charitable giving stuff, I understand people don't want to include that. The sort of the fact that they're looking at a relatively short run estimate, and because the wealth of people is so volatile, you're kind of selecting for people who are kind of have a lot of paper wealth. But here, new fancy sorcery magic. Look at this, bro. Okay, but if you imagine if you have the list of the top 400 people, and let's just say, actually, hold on. Let's say you're looking at it 1 year. Well, let's do 2023, and 2023. You have the list with 400 richest people. You got number 400. 400. This is number 400 on our list. This guy's name is Bob. Okay, horrible. Like if you were to graph, like let's say this is his wealth. Let's say like in 2022, he might have had a couple billion or whatever. The reason he's on the list this year is because his company did really well. He got $1 trillion in unrealized gains, okay, in his wealth, because it's his company blew up in value or whatever. So in this year, he's in a sample. Because this is just like paper wealth, he's not actually paying taxes on this. But then if he were to, like, come 2024, if he were to realize these gains, right? It's like if we do the same thing, everybody starts out, the company gets $1 trillion. If he were to realize these gains, his wealth would go down a bit, probably, because once like founders sell their company and such, you know, that tends to press the value of the stock down, and you know, you're just not earning the same appreciation on it as you ordinarily would. So his wealth is probably going to go down a bit, and he's going to have to pay taxes on that realization. So if you were to graph the amount of taxes he paid, he might pay a lot of taxes in here, and then he's not going to really pay more taxes here because he hasn't realized it yet. But once he realizes it, he's going to have to pay a lot of taxes, and then that means Bob is going to go down to 401. So you're like, they're selecting for the people in this situation who have a lot of paper wealth but haven't actually paid taxes on it yet. Probably a more fair treatment would be to look at longer term tax threats, because that accounts for the fact that he's never actually going to be able to realize all this wealth. Eventually he's going to, you know, drop down to number 401 here. It's going to be real sad. It's going to be real sad. No longer in the 400 list. Look at him. Look at him. Do I have blue? I do have blue. Look, he's crying. He's crying. So sad. Okay. Those are the other issues you want to go over. Anyway. Back to the whatever I was doing at the time after that.
What you have just laid out, which is the difference between making your money via income and then making your money via wealth, via the appreciation of your assets. Just so that we're all on the same page about what this difference is, could you lay out exactly what that difference is? How do the wealthiest, the very, very wealthiest, make their money compared to, let's say, just average wealthy?
Or even average American.
Or average American.
Yeah, so let's start with the tax and the tax lives of most Americans. The tax lives of most Americans is that they earn their money through work, as I imagine the two of you do, and I do, and most of our listeners do, right? And whether they work as independent contractors, whether they work for somebody else, they are subject to the heaviest taxes. They're subject to income taxes at rates up to 37%, and payroll taxes at rates at 15.3% rates. And payroll taxes are paid there. We call them the hidden taxes because most Americans don't even realize that they're taxes. They show up as things like FICA and FUTA. Very hard to understand what they are. They're called contributions, not taxes. But they actually...
It's called the FUTA tax. Okay, we all know that we're taxing the gooners, all right? But, you know, obviously, payroll taxes also create a benefit in the future, right? Now, we don't have a fully funded system in the U.S., so your payroll taxes don't go to, like, your individual account or whatever. But they do, to some degree, entitle you to the future kind of flow of benefits there. Sorry, but like, imagine, you know, in a world without Social Security, probably you would have, you know, private individuals would be saving more, right? They wouldn't have the expectation of getting Social Security benefits in the future. So they would individually save more, and they would have more like wealth on paper that way. But like, you know, if you support Social Security, these types of mandated savings programs, retirement programs, whatever, like you probably think there's an issue with that. And I think to some degree there's an issue with that too. You know, people might undersave. There's just uncertainty with like how long you're going to live. So it's really hard to even know how much you should save. And you might actually have like a, strictly speaking, economic efficiency argument there for pooling savings because of that. So like, you know, these are the liberal kind of arguments for Social Security. I think you're kind of undermining that to a degree when you go out and when you complain about this stuff or whatever. And a big reason a lot of European countries have lower wealth inequalities because of the fact that they have like fully funded pension systems. This is a paper that's just looking at Denmark and a decline in wealth inequality that they saw, and it's simply because their pension system switched from a pay-go system to a fully funded system that explained a lot of the decline in wealth inequality they experienced. And there's this paper looking at similar papers too I have linked, but it just looks at the share of wealth held by the top 10% of 1%, including and not including Social Security. And, you know, if you include Social Security benefits, it's way lower. It's way lower, right? Because Social Security essentially represents an annuity that everyone, not literally everyone, but many people who work are entitled to. And I think it's fair to consider that in your calculation of wealth inequality. I think the Social Security fund is, you know, worth trillions of dollars. So probably worth considering in these types of things.
We impose quite heavy taxes so that a self-employed person who earns $60,000 will pay more than $13,000 in federal income and payroll taxes. That is a significant burden for somebody trying to get by on a $60,000 salary. As people go...
But obviously, you know, they're entitled to not only those benefits, but depending on how rich they are and certain other things in the future, more than what they pay in, right? I think the average person gets roughly, or is at least entitled to get roughly 1.3x what they pay into Social Security. This is some work from Andrew Biggs. He's an economist who writes a lot about Social Security and other potential retirement plans. This is, I mean, he's sorting it by birth year here. So like, you know, 1990, 1.33, the kind of return that you get. This is just a nominal number, but here is the ratio of lifetime Social Security benefits to lifetime taxes. You know, for the middle here, 1.47. Even for the highest earners, 1.01 here, right? So like you're entitled to more benefits than you put in usually, right? Even if you can also argue, obviously it might be a lower return than if you just privately invested it. But there are other, you know, kind of issues with that analysis. Go read fucking Nicholas Barr and his work on it. We're not going to get into that right now.
Up the income tax brackets, the taxes get even more burdensome. So a very high income person will pay typically 50% in taxes, maybe a little bit more if they're in a high tax state. And so they are paying significant amount of taxes. Now let's move over to our wealthiest Americans, all the names that we have all come to know so well: Buffett, Bezos, Musk, all of those fellows. And for that group, they live a very different tax lifestyle. And that's because they acquire their wealth. They do not acquire their wealth from salaries. The one thing all of them have in common is that they take very low salaries. The most highest paid salary of all in that group is Warren Buffett, and he has never made more than $100,000 in both salary and bonus combined.
Humble of him, yeah.
So I didn't look into specifically if that like claim about Warren Buffett and him earning the highest salary is true. Maybe I should, but if you just look at this is the leaked tax returns that ProPublica got in 2021, you know, Warren Buffett reported $125 million in income to the IRS, right? This is the amount of income that he reported. Jeff Bezos, even more, 4.2 billion. Michael Bloomberg, 10 billion. Elon Musk, 1 billion. You know, these people are reporting quite a lot of income to the IRS. And you can see, obviously, their total taxes paid are relatively low. But, you know, we'll talk a bit about that later. But
yes, and he even cuts it back a little bit to pay for the fact that he sometimes uses his office space for his personal investments. So he charges himself for that and further reduces his salary. Jeff Bezos has always...
That point just doesn't... Maybe I'm missing something. I just don't understand how that works. Like, I don't... Because if it's an expense for him, but it's revenue for his company, does company still have to pay taxes on it? Or if his company doesn't pay taxes on it, it'll still like increase the value of the company and they'll have to pay taxes later on. And I just don't get how like that transfer is reducing the tax. I don't get it. I don't know the mechanism there. So you'd have to explain it. Maybe we're missing something though.
Always kept his salary at $82,000, which has enabled him to claim the child tax credit, which he has done in the past. And all the others are just $1 a year guys. And so they take no salary, so they don't pay payroll taxes, they don't pay income taxes, pay very minimum taxes on that side. And so
you can also just look at this paper, which is essentially the only paper to like robustly measure this kind of thing. And it just isn't a case that the sort of rich, this specific measure is excluding the Forbes top 400 because the data on them is harder to get because they aren't included in the survey that they use for the rest of this data. But they have other things that we'll talk about that it does include them. You know, this is just their aggregate borrowing over the aggregate amount of wealth they have. It's 2% of borrowing for the top 1%, right? 1% for the top 0.1% here, excluding the Forbes 400 again. Even for the Forbes 400, the the tax base, the existing tax structures that include or that captures 48.1% of the economic income they have, which is what the authors are measuring that as their adjusted gross income, which is the stuff that's already included in the tax base, plus the the value of their unsold assets that aren't taxed until realization, as they again continually discuss in a podcast. But another funny point, okay, just something funny, is that although sort of individuals might do it more frequently at the top of the income distribution, in aggregate, borrowing and having unrealized gains is actually kind of more of a middle class phenomenon. Americans in the 50th and 90th percentiles of wealth had 18 trillion in unrealized gains in 2022, and had borrowed 7.6 trillion, 42% unrealized gains. While those in the top 1% had unrealized gains of 23 trillion and borrowed only 1 trillion, which is 4% of unrealized gains, right? So they also go over in here a bit later on, just like how much in taxes you would even collect, replacing all their new borrowing with sales of average assets would increase the share of economic income captured by the tax base only marginally by about 1 percentage point. Distribution of all buy, borrow, die borrowing this year as asset sales would raise their average tax rate by only about 0.2 percentage points. Now, she is speaking for the top 1%, but in fairness, she has more solutions than just this later on, and we'll talk about those. But it's not even the case that you would raise a substantial amount of revenue or the progressivity tax system substantially by doing this.
Then why were they not taking taxes? As you said, are they just being humble? No, what they are doing is they are counting on the growing value of their stocks. All of these people own significant amounts of their companies, and their stocks have appreciated extraordinarily in value. So if you look just since 2023, many of them have seen stock growth between like $50 and $150 billion just in the past 3 years. It's been extraordinary, that amount of growth.
Wow.
I mean, if they're making their money because their stocks are going up, well then how are they paying for their lifestyle? Like, you can't buy a Louis Vuitton handbag with Amazon shares. You need to pay with dollars. So if they're not getting salary, then how are they paying for themselves?
Exactly. And the key here is that they are using their stock and other assets as collateral for loans. And they are able to get very favorable rates on their loans because they have so much wealth, right? So this is an extremely well-secured loan, and they borrow lots and lots of money to support their lifestyles. And they borrow
lots of money in absolute terms, again, as a percentage of their unrealized gains or as a percentage of their economic income. Just not that much.
Enough money to cover the interest payments, which are usually pretty modest because of the fact that their loans are so well secured. So they're able to support their lifestyles.
Obviously, she is a little harsher on this in the Ezra Klein interview. Even this language, though, I think kind of implies that this is like unfair. But like, yeah, it makes sense if you have a really well secured loan and you are a billionaire who not only has a lot of assets that you could use to cover the loan, but probably have some reputation as being financially prudent. Of course, you're going to get a favorable interest rate. Like, yeah.
And they're borrowing by borrowing. Now, some Americans might think, yeah, but surely they've got to pay that money back, because the rest of us are used to loans where we're given maybe even 20 years for a house loan or 30 years, but our other loans, they want them back in a set period of time. The difference is, for the very wealthy, there are all sorts of people in the business of lending money. And when you have these very well-secured loans, there's always people ready to just lend you money and to keep lending you money on that loan because they get paid for that service of lending money. And so
believe it or not, that's also the case for like almost anyone in the middle class. Like
a problem rolling over.
Yeah, you might have a higher interest rate, but it's because you have less assets. You're more risky.
Loans or getting somebody else to give you a loan. These loans don't really have to be paid back because of the big market of people that are in the business of lending money.
I'm just not sure what the evidence for that is. Now, I imagine to the extent billionaires do borrow against their assets, right? Like, yes, it's going to be in favorable terms, and oftentimes I bet they might I doubt they literally pay it back with another loan, but they might, in a sense, effectively do that if they just immediately get another loan and have to, even if they have to sell some assets to pay off the old one or whatever. But like, evidence, please. I couldn't really find anything on it. I'm certain there are anecdotes of it happening, but I couldn't find anything substantial.
Glad that you laid it all out for us there, because I just want to make sure that all of us are on the same page here. We're not saying, or you're not saying, that the lawyer or the doctor who's making $300,000, $400,000 a year isn't paying enough in taxes. Those guys are paying, as you say, 50%. in taxes in many cases. What we're saying here is that there are a handful of billionaires who make their wealth via the appreciation of their assets. And because of the way that the system is set up, where you can essentially just borrow against those assets, and especially at a very low interest rate, the more money you have, what it basically means is that you can get by as a billionaire paying almost nothing in taxes. And that's the point.
The only tweak I'd like to make to that otherwise perfect description is that we're not just talking about a handful of billionaires. Somebody who has $100 million could still do this, right? And so it's a much larger group.
It's interesting she makes that point because, like I said, because of the data issues with the top 400 list, they're excluded from the survey that we use to get an understanding of the assets that a lot of rich people own and their general income. It's harder to get estimates for exactly their effective tax rate or exactly how much they borrow against their assets. But once we expand it just to the people of over 100 million or whatever, we can start looking at the top 10, just top 1% of people. We do have a lot of data on them. And again, it's just not the case that they engage in the buy, borrow, die system that much. They tend to save a lot of their money. They tend to have enough economic income to pay for their lifestyle. And the middle class, just as a percentage of the unrealized gains, actually borrows more.
Group. I think we make a mistake
in aggregate
when we describe this as a billionaire problem, because the problem really is for anybody who has enough assets that they don't need to work, they can depend on the growing value of their assets, they too can avoid taxes. And that's why our system is so problematic. It's because it loses so many people. And that's the real problem.
So Professor Nettle.
Now, I'll also say we frame this as like an evil thing or whatever, that the older people who own assets are paying less than the rich people, the doctors who are already paying 50% or whatever. I can understand having the issue with the tax system insofar as you believe that to be true. Obviously, I don't believe that to be true, but also it seems like it'd still be, if the view that inequality is bad, right, is true. You should also probably care about income inequality, and a lot of income inequality is driven by not people owning assets and not having to work or whatever. It's driven by the fact that there are payment differences between firms. So this is a Nicholas Decker sort of summary of this paper, firming up inequality. I've not read this full paper, but I have read this short little blog post. We just look at a bunch of data from U.S. firms between 1982 and 2012, almost like most of the increase in inequality has been driven, income inequality has been driven by the differences in payments between firms, not within firms. Since 1982, the median worker has seen their real pay rise 20%, while the pay at the top 1% has seen their real wage rise by 94%. However, this has been due to changes in the fortunes at the firms for which they work. The median worker works at a firm which has seen its real median wage increase 25%, while the top 1% works at a firm which has seen its mean real wage increase 105%. This is a broader conceptual thing. You don't have to understand that, but presumably, if we view this as bad, you also do want to address that, right? And I'll come out and say it. Okay, I'm a libtard. I might have opinions on the optimal tax system, but like absolutely, fuck them, doctors and lawyers or whatever. I don't care if you're working still. If you're making a fuck ton of money, you gotta pay. We're redistributing a fuck ton of your money to all the brokies out there. Okay.
Well, bridge us nicely into, I think, possible solves. I want to propose 2 possible solves and get your response. I think what we want are taxes that are the least taxing. And one of my intellectual role models is a guy named Daniel Kahneman, and the Israeli-American psychologist who writes a lot about money, and basically came to the conclusion that money does buy happiness, but it flattens out at a certain point, which says to me, if we're in fact going to need...
This is why you guys should all take the 10% pledge and donate your money. Not only should you take the 10% pledge and donate your money, you should impose a 100% marginal tax rate on yourself after you reach $200,000 a year or something, and donate it all to the Shrimp Welfare Project and give well and long-termist EA charities.
To fund our Navy and our parks.
Unironically.
The least taxing tax would be an alternative minimum tax. I think trying to redo the tax code, which has been weaponized by wealthy people and corporations, would be a fool's errand.
True. So least taxing tax. I think there's 2 ways to understand that. One is like administratively least taxing to impose, and 2 is in terms of like economic efficiency, deadweight loss. Least taxing causes the least deadweight loss to impose. I think under both of those sort of views, I don't know why we would think the alternative minimum tax would be the best way to do that. So, for one, depending on how it's structured, you're going to run into a lot of the same problems that you're going to run into with like a wealth tax and real gains tax or estate tax, even when it comes to like valuation issues. I think depending again a bit on how it's structured, you're just kind of making people do a lot more work, and assessing to see that if they have to pay it or not, because alternative minimum tax, as it implies, is an alternative to the existing tax structure. People have to see if they make enough income to qualify for it, essentially. So I just don't think economically, in terms of like deadweight loss or whatever, you're essentially you're kind of either one, because of how you have it structured, where certain things are allowed to kind of be exempt from it. Like, for example, are we including like privately owned businesses? Like, do we include like the value of them in the alternative minimum tax? Like, if I own a business, I own 90% of it or 100% of it, does that have to be valued and accounted for in this alternative minimum tax? Because if it does, you're also giving an incentive to not hold on to those types of assets, and there's a not only administrative problem there, but just economic efficiency problem there, insofar as you're discouraging people from sort of holding their desired portfolio of assets. And additionally, in creating these things in the first place, right? Because at the end of the day, you are just sort of increasing the after-tax return to investment there, right? So you're gonna have those administrative efficiency issues as well.
But an alternative minimum tax of say 40 or 50% on any income, investment gain, or if you borrow against that, that's a trigger for capital as an event. An alternative minimum tax of say 40% on corporations. And then the second thing would be to lower the estate exemption from 30 million to 1 million. And I believe no one gets hurt, no decline in the quality of life, and you can fund the programs.
Don't you know, it's just that easy. There's no decline in the quality of life at all.
It's substantial.
50% tax on any investment gain over, did he even specify an amount? He specified for the estate tax to lower it to $1 million.
Say 40 or 50% on any income, investment gain, or if you borrow against that, that's a trigger for capital.
He didn't even specify it. And if you borrow against it, which again, as we read earlier, is just not like a big deal, and therefore wouldn't raise that much revenue or wouldn't make the tax system substantially more progressive. But also then you're, again, just essentially discouraging, you're still reducing the after-tax return to investment. You're limiting a way in which it can be realized.
And would be to lower the estate exemption from 30 million to 1 million.
No decline in the quality of life.
I believe.
We'll get into estate taxes a bit more later. The girl really likes talking about estate taxes. I think your view there is not totally incoherent or anything. I think she is fine there. And I think the estate tax is like not a necessarily particularly inefficient a tax. There are valuation problems, and there is currently a lot of avoidance with it. But,
no one gets hurt, no decline in the quality of life, and you can fund the programs that substantially increase the quality of life and general well-being and happiness, universal child care, food stamps, tax credits for young people trying to buy homes.
Wow.
We put forward to you.
No one gets hurt if you have tax credits for young people trying to buy homes. There are no potential ways in which that could hurt people.
To nullify or validate my thesis that the illusion of complexity has been weaponized by the incumbents. Get rid of the estate tax exemption, alternative minimum tax on any income above $1 million or corporations making above a certain amount.
I agree conceptually that we need to bring in investments and inheritances. I think that description is a little bit, I want to push back a little bit on it, because the alternative minimum tax is what that is it's something that disallows deductions. Mm-hmm. Okay, so you can't take a charitable deduction, you can't take a home interest deduction. It doesn't do anything about the problem that we have in our system of the failure to tax appreciation, which is a problem of realization that's separate from deductions, and about the failure to tax inheritances, which again are subject to broad exclusion. So the problem that we have, as I see it.
So I don't think it would tax inheritances, but some proposals for the alternative minimum tax, we already have one, but like for expanding it in the way that he said or whatever, like that would tax depreciation, right? Like he said, any investment income you get or whatever, if you get a loan and borrow against your assets, that's going to trigger it as well. Like his alternative was doing that. So I think insofar as you try to include those things, almost essentially in any sense, you're going to have those valuation problems and efficiency problems.
As a tax person, I share the desire for the solution, which is we need to bring investments and inheritances into the tax system. But I disagree with the alternative minimum tax and estate tax framing. The alternative minimum tax, for that reason that I say, the alternative minimum tax is really about deductions. And so it's not really about all these things that are written out of the system. You say, well, then we should write them into the system. So that's how I would focus on it. I agree. We should bring in appreciation. The problem is if you tax appreciation as it occurs currently each year, right? I don't know if you're proposing that. That was one of the, right? So how are we going to handle this appreciation, right? We have all these guys that are walking around with hundreds of billions of dollars. When are we going to tax those gains? And different proposals have been made, right? Some say we should tax them each year as they occur. I think that's going to be too burdensome and too complex for people to understand. So what I think we should do is say that whenever the person transfers the property, whether they transfer it by gift, whether they transfer it at death, whatever they do with it, once they no longer own it, then they should tally the gains and pay taxes on it then so that the person...
Two things there. Number one, yeah, you're not going to have the issues with administration and evaluation every year, but you're still going to have that every time they transfer an asset, right? That's a little administratively taxing, more administratively taxing than many of our current taxes. And I don't even think those are the most efficient ways we could do things. VAT would be less administratively taxing than our current income tax system and such. But number two, holy lock-in effect, bro. Like, so the assuming most of my audience has heard of it, and from the name, they can probably infer what it is. But, currently, like capital gains tax, because we tax it at your asset at realization, there's a lock-in effect in a sense that you are kind of incentivized to hold on to the asset for maybe longer than you would otherwise prefer to, because if you realize it, you're going to have to pay taxes on it, right? So maybe in a world where there weren't any capital gains taxes, if you thought a company was going to do a little bit badly in the future, you'd want to sell its stock and get another one, or save that money or consume it. But because you have to pay capital gains tax when you realize it, now maybe you're saying, okay, well, it's not actually worth it for me because I'm going to have to pay a fuck ton of money in taxes, and I'm not going to have money left over to do whatever investment that I might want to do otherwise. If you're saying we're going to tax all your unrealized gains, potentially even your privately held assets that are hard to value, like privately owned businesses or real estate or art and such, anytime you want to transfer it, holy lock-it effect. You're really discouraging people from kind of owning, again, the portfolio that they would prefer to hold.
Who earns that?
And that also limits, of course, to some degree, just entry into whatever stock market or whatever, because now people know if I need to sell one day, I'm going to be fucked over, right?
Income, earns those profits, pays taxes on them. Our failure is to not tax the appreciation to the person who earns it by letting them pass it tax-free. In Canada, they have this rule, which says that whenever you transfer the property, we're going to tally the gains, and I think we should have that rule here for purposes of...
And what's the real GDP growth in Canada? That's what I thought. Causal inference is my passion.
Investment gains.
I 100% agree with that. What you're basically saying is, what is the trigger for when something becomes a capital event where it's subject to taxation?
Yes.
And the basic strategy now is buy investing in your own company or buy stock, borrow against it, and then die and get a step up in basis. So I think we're brothers from another mother here. I think the wealth tax is class welfare. I think it makes for a speech. All you're going to do is fill the pockets of every accounting firm and trying to assess value. I can't imagine what a boon it would be for appraisers trying to convince you that one property is worth negative value, and then try and figure. And we've talked about this. 16 countries have proposed.
True, but like again, I just don't see how. I don't see how they sell that. It might affect them to a low degree, to the extent they're just not taxing these assets as much, but or as often, I should say. But you're still going to have all those problems. Or if you just have a smaller base, but then just having, depending on what you include and don't include in the base, you're creating distortions there, right? Because if you don't include private businesses in the base, well, now you're like discouraging companies from going public, right? And we probably want companies to go public if they want to, if they think that's a good option.
So wealth tax, 13 have repealed it. They typically just don't work very well. But the only thing I would add to you in terms of it triggering a capital event that's taxable is when they borrow against it.
And that's fine. I'd be perfectly happy to do it. I think there are some problems because, first of all, you can borrow against any number of assets, right? You might have lost assets that you can borrow against. So it's not really clear. And also, people's borrowing is very small in relation to their total wealth. So the only thing I'd be...
What? She's read the paper. What?
Concerned about when we talk about taxing borrowing is I wouldn't want that to be seen as the solution to the problem. Because when somebody has $200 billion...
And I think there, like, one, would seem to kind of imply that I understand she wants to do other things as well, but insofar as you try to bring in the loans into the tax system, the tax structure, or even appreciation, you're just not like you're not making the tax system substantially more progressive. And then two, the reason people view it as potentially the solution or whatever, the reason people view it as a problem
is I wouldn't want that to be seen as the solution to the problem. Because when somebody has $200 billion, you can live a pretty good lifestyle with just $1 billion. Hard to believe. And
the reason we care about sort of the loans there is because that's what enables them to consume, right? This is an awesome freeze frame, by the way. Look at this smile, bro. We gotta make this a thumbnail. Actually, I'm gonna screenshot that right now. But that's what enables them to consume, and that's, for the most part, the issue that we take with inequality is insofar as it creates differences in the quality of life of people because they consume. It doesn't really matter if someone has $1 trillion, bajillion, quadrillion dollars in their bank account if they don't actually get any added consumption from using it. What we usually take issue with is the fact that they have, or at least have the option to buy mega yachts and buy smaller yachts to live in their mega yachts. This is what we take issue with because it's, seems unfair, or there's just diminishing marginal utility to consumption, et cetera, et cetera.
So then we don't want people to think they're solving the problem by taxing borrowing. So that would be my only hesitation as you and I are fine-tuning our tax systems.
The solution, by the way, the real solution, just do a consumption tax. Just do progressive consumption taxes. That's simple. It's that simple.
See enough realization events for the appreciation of assets, and you keep on borrowing, you borrow against your assets continually. You never have that moment where you sell those assets and then realize the tax. And so you're saying anytime there's any transfer of any kind,
again, they report a lot of their income to the IRS still.
If you donate it,
they pay a lot in taxes still. They're borrowing as a percent of their economic income. It's just not that high.
If you transfer it into a new account, that is a moment to say, okay, let's figure out how much the assets have appreciated and let's tax them.
So I just remember this, by the way, even our point about you can live a pretty good life on $1 billion. That's true. There's diminishing marginal utility to your consumption. And that also means that billionaires just don't need to realize all of their wealth. They don't need to take out loans to realize a bunch of their wealth because they can live a really fucking good life on just a small portion of it.
One thing that is confusing to me, though, is we do have a moment where rich people do transfer assets, and that is when they die, and they hand it over to usually their children. And so the question for me is, and this is the estate tax, we tax those assets. Why isn't that working? Why is that a problem still?
And that's a really important part of this conversation of understanding this issue, because we have all these seeming failures in our income tax system, right? We don't tax appreciation. We also don't tax money received by inheritance. So if you find $100 on the street, you leave your office, you found $100, you are supposed to report that to the IRS and pay taxes on it. However, if somebody hands you $1 million or $10 million or even $10 billion, you don't even have to report it. You don't have to tell anybody. You don't have to pay any taxes.
$10 billion free dollars.
Applies to money you receive by life insurance. And
$10 billion tax-free dollars. So, to be clear, I think where she's right is that the estate tax, one, has a lot of avoidance. Two, it's been declining over time. The amount of revenue raised and how high the actual rates are and such. And I think there's a case for raising it. But also it's just frustrating because she was even more clear about this in the Ezra Klein interview here. It just isn't the case that you get $10 billion tax-free. What you get is some type of trust. What you get is some type of, portfolio that has limits on it if you want it to be. If you want to give it without taxes to people, like she mentions the Dynastic trust here or whatever.
Even better are devices where somebody creates. Dynasty trusts are fascinating because the purpose of the estate tax was to avoid dynastic wealth, right? And it's a sign of how flagrant the estate planning can be that they actually just call these dynasty trusts. yeah, we know they're supposed to not have dynasties, but we got dynasties for you. And what they do is they create
Evil.
for your children, grandchildren, great-grandchildren, great-great-grandchildren, forever in perpetuity to benefit from this trust and the growing value of this trust. And they get funded through a lot of complex arrangements, oftentimes through sales. You will sell your stock early on to this company in exchange for a low-interest note. And for estate tax purposes, you've gotten it out of your estate. But for income tax purposes, you're treated just as if you're dealing with yourself. So you pay no taxes on that transfer. And these dynasties...
But she kind of presents it here even in a, I think, somewhat unfair way. You see how this is not equivalent to $100 you find on the street. You see how there are a lot of restrictions on what you can do with this money. Usually, like, I believe with a dynastic trust or whatever, I believe the heirs to it don't even get control over exactly what they invest in. But I think I was a little bit wrong. So, the person who creates the trust, they can make rules and such for it, but they don't necessarily have to. So I believe they could. I don't think there's anything necessarily preventing them from saying, my kid can essentially have effectively full access or control to the trust once they die and it's transferred to them. But if they do in a lump sum, I think they do have to pay taxes. Funding a dynasty trust can be done in a lump sum gift or spread out over time. If a grantor chooses the latter approach, they can use their annual gift tax exclusion, currently in 2024, $18,000 per donor, to an unlimited number of recipients to help minimize their gift tax costs, reduce the amount of the lifetime gift exemption used. For lump sum gifts, the grantor must report them on their gift and generation skipping tax return for the year in which the gifts were made. Rather than giving beneficiaries full access to the funds, grantors commonly limit distributions to funds used for health, education, maintenance, and support of the beneficiaries. Demand additional incentives, such as authors. So I don't know if there's anything necessarily in that tax system preventing you from granting basically full control over it to the trustee, but it's still somewhat limited. Most of the vehicles, I'm not committed to the claim that they're fair, to be clear. Right, it might be more preferable to have the older estate tax system or not exempt many of these things, but it's not literally just money that you can do whatever the fuck you want with, even if the trustee doesn't attach, or the grantor, sorry, doesn't attach rules. The trustee usually it cannot just like use his money, however, it's not equivalent to just a cash transfer. This is, Saez-Zucman work here. Take that as you will, but they at least say that a substantial part of the decline was the decrease in estate taxes with regards to effective tax rates, the change in them from 1960 to 2004. And this is just a paper that looks at the sort of share of inherited wealth across a lot of countries. Like you can see, it goes all back to 1900 here for the U.S. It's not like it's increased a crazy amount or anything. It's roughly where it was in 1930, which is like not especially concerning. That's not typically the type of typically we're trying to compare to the evil Gilded Age. I mean, it goes back here. I don't actually know if this is for France. I don't know if they have one that goes that far back for the U.S. No, it goes back to the 1900, but this is for the stock of inherited wealth as a percent of private wealth. And like, this is, to me, like not a particularly concerning trend, even if you could still definitely argue that it's too high. This is just inheritance over national income, whatever, black line. We only have data on this one apparently. Damn. But it's across some other Western countries. There definitely seems like a U shape to this one. And there's to some degree a U shape in the US as the share of inherited wealth. But like, I don't know, it's just it's not a particularly concerning trend to me overall.
Insurance and money you receive by gifts, all of that is entirely tax-free. Well, why do we have this enormous giveaway in the...
I don't really understand. The life insurance thing just seems really stupid, but...
income tax system?
Like with regards to not her saying that, with regards to that being exempt from any taxes, I don't see that. I don't see the justification for that.
The answer is because we count on a robust estate tax system sweeping up and making sure that these untaxed forms of income are eventually subject to tax with what had previously been a pretty onerous tax. The estate tax was enacted just a couple of years after the income tax, 1916. We've had it a long time. And for a long time, it did its work. Basically, we had a tax and we had a Congress that kept up with reforming the tax. So in 1976 and 1986, we had a problem of these long-term trusts, and Congress enacted this whole additional tax as a backup called the generation skip and transfer tax. Then we had a problem with valuation gaming techniques. So 4 years later, Congress enacted special valuation rules and a whole other a whole other section to the code. And these were both enacted under Republican presidents. So this was broad bipartisan support, supported keeping this tax up to date. However, what you and your listeners might remember, or I guess maybe Ed, you might not.
I mean, not to do a causal inference is my passion thing here. It's like we didn't really see in the decades following those reforms, it go up substantially. It wasn't until like 1990 where you saw the stock of inherited wealth go up again.
Not remember it, but maybe you've heard of it.
Although actually, I don't know. This might be This might be pre-tax. I don't know for sure. Actually, I don't know. It fell abruptly. Called destruction, inflation, taxation. So it's got to be after tax then, if it caused it to fall.
Beyond loopholes, one thing that's also interesting, we were discussing the difference between capital and labor. And outside of these loopholes and outside of borrowing against the assets, the reality is the tax rate on capital gains is just significantly lower than the tax rate on income. We have this chart here from this 2022 study, which shows that the tax rate on capital actually used to be higher in America compared to the tax rate on labor, and then recently it flipped.
What's funny is they don't actually show the chart. That is another Zucman paper.
But also, I would point out that this has been the subject of debate on like how exactly are you calculating what that tax rate is on labor versus capital. Also, Gabriel Zucman, who's written a lot about this, he did a study and he said
the name drop
as recently as 2018. So there's all this debate on like what actually is the true tax rate on capital versus labor. But the larger point being, should we really be taxing people's work, people's income?
I believe this is what they're referring to. I believe it's always been higher on capital in these, and except like maybe like a little bit there, this one, or maybe it's like about to flip here. Regardless, I believe this is these were the charts that they were trying to show.
At a higher rate than the income that they receive or the appreciation that is realized on the appreciation of assets. And I just like to get your views on that. Should we essentially be just increasing the capital gains tax?
We absolutely should be increasing the capital gains tax and equalizing the ordinary income rate. There's a lot of, you'll get 50 reasons about why people who want to keep that reduced rate, all sorts of reasons that they have, but none of those 50 reasons actually stand up on their own. And so I believe absolutely we should be equalizing.
So the phrasing there is a little weird, just because none of the 50 reasons stand up on their own. Okay, does that just mean like every individual reason is not sufficient on its own? Because I think that's, if you just want to argue that, that's fine. Because if you have 50 good reasons for something, even if none of them are sufficient on their own, maybe 50 good reasons or 50 okay reasons is they amount to a good reason altogether. But regardless, listen, I like the concerns generally there. For one, to some degree, it's double taxation, right? So the income that you earn from labor, or the income that you get even from capital gains, that is already or other types of gains. We're discussing capital gains here. I retract me saying from capital gains. That is taxed already. So you're being taxed on the income that you generate from labor, and then you're also being taxed on the returns you get after you invest it. You're kind of distorting the like temporal neutrality there, because you are taxed differently whether you save your income and realize it later, or if you spend it now, or even save it now, so it cuts your income tax, right? So that is one distortion there that we generally don't want to have. The other distortion is that you're just reducing the after-tax return to investment, to engaging in activities that give you capital gains. And I think we have reasons for thinking that most of those activities are just generally good, generally lead to an efficient allocation of capital, generally lead to people investing more, generally lead to people, saving more, which is what finances investment, right? Even okay, we got Econoboy, okay, full-blown socialist Econoboy arguing against capital gains tax here. This is one of his posts. Very good entire series, The Left Needs Better Tax Policy, despite all the disagreements me and Econoboy have had. And we have had several, on stream before he retired. Retire in peace, Econoboy. he makes this the same point that we should be concerned about the disinvestment incentives that capital gains tax has, and just do a progressive consumption tax, an expenditure tax instead. And he also makes a point about lock-in effects, and also the point about double taxation. In fairness, we provide a lot of kind of exemptions for that stuff. So like this is a paper, not specifically about like capital gains, but about corporate income generally, because we provide so many exemptions, like different investment accounts or whatever. Several factors explain the shift, including changes in retirement finance, demographic changes, changes in the prevalence of pass-through business organizations, and the increased globalization of capital markets. You know, because of all these factors, essentially, the vast majority, they say, of corporate income is not actually double taxed, but it's still going to affect capital gains tax a bit more.
The rate. The one thing that I think that we could do is we could provide inflation adjustment for recognizing gains. So let's say that somebody buys a house a long time ago, they buy it for $100,000 and now it's worth $1 million. But inflation has gone up so much that their actual gain, they're not really better off by $900,000 because that money isn't going to buy as much anymore, right? They can only just buy that same house or buy a less good house. I'm not explaining this well. But a lot of that gain will be due to inflation. And so I think that we could equalize rates, but allow for adjustment for inflation of basis so that people are not paying taxes on the inflation gains. And that would be a way of softening that as it applies to long-held assets.
That seems like a great solution to me.
I think I doubt the effect of that would be that big either way, honestly. But inflation already has the effect, because they're based on like nominal rates, already has the effect of like pushing assets into like higher tax brackets.
That seems like a great solution to me. Just make them equal capital gains and income tax, just make them the same. The thing that has confused me, though, is that I'm not aware of any societies, or maybe Western societies, maybe I'm just not looking hard enough, where that is the case. And I guess my question is why? Why is it standard that capital gains are taxed at a significantly lower rate than standard income?
Well, first of all, right here in the United States, they were taxed at the same rate in 1986. This was a tax bill. The 1986 Tax Act was put forth by President Ronald Reagan. And I think that what he did was he brought down rates, but equalized capital gains and ordinary income. So it's definitely something that can be done.
Don't ask what she wants to do to top rates.
And one of the things I talk about in my book is how Andrew Mellon,
also not really an answer to the question about at least why no country does it today, but
was one of the early Treasury secretaries and was very conservative, a staunch anti-tax the rich kind of guy, wrote himself that he saw no reason for taxing capital less than labor. And indeed, he thought capital should be taxed much higher than labor because capital is something that grows without anyone's effort, whereas labor is something that requires a lot of work.
First of all, Andrew Mellon, limited by the econometrics of his time, okay, and not even the econometrics of his time, the economics of his time. This dude was alive during the Great Depression. I forget when he was born or anything, but not someone whose like work should necessarily be taken as credible in today's time, and not to character assassinate the dude or whatever, but like there's a quite famous quote of his from during the Great Depression: "Liquidate labor, liquidate stocks, liquidate farmers, liquidate real estate. It will purge the rottenness out of the system. High cost of living and high living will come down. People will work harder, live a more moral life, values be adjusted, and enterprising people will pick up the wrecks from the less competent people." Like this was this was not even an uncommon thought of his time necessarily. That like, oh, actually this recession or Great Depression, and in his case a depression, they're good because they eliminate all the unproductive companies, okay, liquidate everything, purge the rottenness, and make people have to work harder and make some more business or whatever. Like, this is not a view that I don't think that you would accept of recessions today. And then with regards to so I don't think it's necessarily a good justification for saying that just you have to actually work for labor.
That he saw no reason for taxing capital less than labor. And indeed, he thought capital should be taxed much higher than labor because capital is something that grows without anyone's effort, whereas labor is something that requires a lot of work. And so
I think what matters is essentially economic efficiency provided by them. So it is true that like, obviously, when you invest money, oftentimes you are not like putting in active work to make it grow, whatever, but usually you're providing financing to a company that is now able to invest and provide jobs and do whatever because of it, or you're providing liquidity to people and they're able to, shift their portfolio into assets that they think is preferable because of it, right? Like you're providing genuine value by when you do these things. Like this obviously does increase economic output, and I think that's primarily the effect that you should care about. Not to mention, again, you are taxed on the income that you get to invest in the first place, right? At least insofar as you have labor income. Obviously, other types of income might not be subject to the same taxation, but even if you realize capital gains, there is a capital gains tax currently, so you are taxed on that before you reallocate it.
I think that this is it's definitely doable, and we've had it in our not so distant past.
Is there an argument that maybe it reduces investment, or that it could, just have an overall downward effect on, I guess, the stock market?
One argument that you'll often hear is somebody will get very wonky, and they'll say,
very wonky.
The statistics show that if you raise
We're bringing up statistics.
capital gains rates above a certain amount, then you stop raising money because people stop selling their property. Something like that, right?
Bro. Sometimes people get very wonky. They bring up the statistics and they say the Laffer curve. Like, bro. Yeah. Obviously, raising capital gains tax beyond a certain point will reduce revenue, but I don't think that's the primary thing that we should care about, because first of all, the revenue maximizing rate is different from the efficiency maximizing rate, or the growth maximizing rate, or the utility maximizing rate, right? So the primary concern I have is just reducing the capital stock. It's just reducing the amount of investment that people do generally. Insofar as you're decreasing the after-tax return to investment, people generally are going to do less of it, and that is kind of just what generally is responsible for productivity growth over time, and even for, therefore the wage growth over time as well, right? Like that, like oftentimes it is doing financing investment that ends up increasing workers' productivity, and therefore generally increasing workers' wages as well. That's a good thing. We should want that. That expands output.
Right.
And related to the part, people aren't going to sell or whatever, there is a negative to the lock-in effect as well, insofar as people aren't shifting their assets to more preferable assets to hold on to. Lock-in can trap capital in inefficient investments that might be used more productively elsewhere. The argument is clearly most relevant in the case of small privately held business, the proprietor of which might keep it might keep it going long after it should have been shut down. Is less relevant in the stock market. Even if taxable individuals are reluctant to sell shares of a company they expect to perform poorly, pension funds, which hold about half of the stocks, and this is more by now, this book is old, and foreign investors are unaffected by capital gains tax. They quickly sell their shares until the price reflected the prospects of the company. As a result, they'll lock in individual investments. Individual investors should have little or no long-run effect on asset values, although it might affect the speed of adjustment in the market. The lock-in effect can still be costly to individuals. They might find the tax of costing realizing capital gains prevents them from diversifying or rebalancing portfolios. That inefficient level of risk bearing is part of the excess burden of the capital gains tax. This burden might be large enough to make a cut in the capital gains tax beneficial, even though it might reduce net national savings, depending on how sensitive realizations and corporate dividend payouts are to the tax on capital gains. There is this argument, which is interesting. Some analysts have questioned whether individual trading is based on information, knowledge about future prospects for assets, or noise, ignorant speculation. If individuals are primarily noise traders, market efficiency is not enhanced by trading. In addition, there is some evidence that investors may overreact to short-term information, such as firms' reports of earnings and profits, while discounting long-term prospects of firms. Trading based on short-termism may cause asset prices to systemically deviate from the inherent value of firms. Noise trading can increase the variability of market prices and make it harder for expert traders and arbitrageurs to extract information about the true value of investment. Such trading carries additional social costs because of the transaction costs involved in non-optimal trading. Thus, lock-in may actually be socially desirable. To the extent this is true, probably it'd still just be better to do a short-term financial transaction tax as opposed to how the capital gains tax is structured currently. And I just don't, in fairness, I haven't seen like super convincing evidence either way in this point. But I don't think it happens that often. depending on how you measure it, because there are definitely cases, like you can look up, I don't remember the companies involved, but there have been stock traders who, literally buy a perfectly straight or build a perfectly straight wire so they can get information just a little teeny bit faster, a few microseconds faster than their competitors, and therefore essentially trade on arbitrage. Like, this is just Wikipedia. According to a Forbes article, the idea for the line first came to Dan Spivey in 2007. Spivey contracted with a New York hedge fund to devise a low latency arbitrage strategy, wherein the fund would search out tiny discrepancies between future contracts in Chicago and their underlying equities in New York. Although he successfully created a strategy, he was not able to execute it because he was not able to get access to the market's low latency line. He spent some time researching the feasibility of building ultra low latency line, and then looked for people willing to fund it, and found Jim Barksdale. Construction was in full swing, but in extreme secrecy to avoid getting scooped by competitors by early 2009. In 2011, Spread Network expanded to Equinix. I don't know how to pronounce it. NY4 IBX data center in Secaucus, New Jersey, 300 Boulevard East in Weehawken, New Jersey, and 165 Haysdale Street in Newark, New Jersey. In October 2012, Spread Network announced latency improvements, bringing the estimated round-trip time from 13.1 milliseconds to 12.98 milliseconds. In January 2014, Spread Networks announced that it had opened a point of presence at the NYSE, or the New York Stock Exchange, Euronext Trading Center, located in Mahwah, New Jersey. Incredible. There are people who do this. I'm not sure exactly how widespread it is, however.
But the reason that that is the case is because we allow people to avoid capital gains by avoiding sales. The problem was that loophole. If you close that loophole, then people will not be able to avoid capital gains. And that is one of these arguments that looks and sounds.
But you got to run into the same valuation problems, the lock-in effect again.
Really persuasive, but really isn't when you look at it.
We'll be right back. And for even more markets content,
to get your money.
You're still raising the overall burden on investment, so you're still probably reducing investment and such. So we're gonna skip past a little bit of this because they ask about her kind of ideal system and solutions, and she kind of just repeats herself, right, about state taxes and income tax reform and such. I will bring up just this part.
31 exchanges are putting things into an LLC. Doesn't matter. As soon as it changes title, it's taxed.
Absolutely. When you change title, you're subject to tax.
Just like holy lock-in effect and stuff. But then what's interesting, they ask her about a wealth tax.
I was going to say, not on that list is a wealth tax, which is the most popular proposal in the political sphere right now, making ground in California. AOC has been talking about it. Why no wealth tax?
I think that we all understand now that the problem is that wealth owners have enormous acquisitions of wealth and they're not paying tax. And so the obvious answer seems to be, let's tax their wealth. And particularly for people who have publicly traded stock where we can so easily see how much wealth they have. The problem is that sometimes these easy answers don't actually work. And I feel that's the case with the wealth tax.
To your point, a wealth tax is what I think my party does a lot. And that is they want to be right as opposed to effective. I think a wealth tax makes a lot of sense, but they don't work because wealthy people are incredibly mobile. Capital is incredibly mobile. And also, I think on the corporate side, and I'm curious, even going broader, don't you think we're going to need some sort of, and to her credit, Secretary Yellen was able to get this through.
So real quick on that point, it's true that to some degree, at least, capital is mobile. But it's also important to recognize just like the more mobile capital is, the more the actual burden of the tax is going to fall on workers. And now he's, in some sense, agreeing. He's not explicitly saying that, but he's saying it doesn't work by nature, the fact that capital is mobile. But obviously, to the extent capital flees, that capital is still earning return somewhere else, even if it's like earning a lower return. But the workers there might not be as mobile, and if there's not investment in that area anymore, then they're the ones who essentially end up bearing the burden of that tax. This is a informal and meta-analysis type thing that looked at a bunch of different studies about the incidence of corporate gains taxes, and I don't take a strong view on which study here they mention is correct or anything. But I'm going to bring up capital is mobile and firms can relocate production across borders. The burden of corporate taxation shifts away from capital and towards labor. The idea is that when capital moves in response to tax differentials, the domestic economy experiences a reduction in the capital stock, which diminishes workers' productivity and wages. There's some empirical evidence of this. It's just kind of hard to do this type of research. German economist Clemson Frost I don't know how to pronounce that. I'm assuming I got it right because I said it in a funny way. That's how Germans speak. Leverages regional data from Germany, reveals that workers in regions with higher corporate taxes experience substantial wage reductions, with labor bearing approximately 77% of the corporate tax burden. The study is a valuable contribution to the literature because it moves beyond general theoretical models and uses real-world data to assess the impact of corporate taxes on workers in different local tax environments. Yeah, it's actually, difference in differences, guys, not just is associated with, which I'm assuming means we did a regression. We did a OLS regression, guys. We did it. I have solved every econometric problem by simply doing a cross-country OLS regression. You'll never believe it.
I think that's right. Unless we get other nations to cooperate and unilaterally enforce some sort of corporate minimum tax, you're going to continue to see taxation not realized or revenues not recognized where they're realized. There's still going to be all sorts of arbitrage internationally taking place, no?
I want to add one.
The solution to this, by the way, is a DBCFT, baby. Or for that matter, any destination-based tax. So the VAT is also a destination-based tax in that you're taxing based on where the good is consumed rather than like the origin of the product or the origin of the company. The US, like our current corporate tax structure, we have like an origin-based system where companies can avoid taxes by technically being headquartered in the Virgin Islands or technically being headquartered in Ireland, and like Apple and such would only like station some of their company in Ireland, and they were able to avoid taxes through some of that loophole. DBCFT or VAT would essentially get rid of those because it get rid of those avoidance strategies via simply taxing based on where the consumption of the final good is done. That's why people are mad that European countries have a VAT. They're taxing our imports, and they export subsidy. They export subsidy. Because exports are exempt from the VAT, they get a rebate. And it's evil and unfair. I'm kidding. VAT, DBCFT are, in a perfect world, at least trade neutral. They might have some minor distortionary effects, but in a empirical world, they are also very close to trade neutral. We have a study on this from changes to VAT levels in different EU countries did not have any substantial effect on trade flows.
The thing about the estate tax that makes about the wealth tax that makes the wealth tax particularly problematic, which is the problem of valuation, as you mentioned earlier. We tend to think of it as like publicly traded companies, but lots of people own these highly complex partnership interests that are like 50 levels deep of partners, and people might own levels at all different places. And the idea.
But I don't understand, if you're saying we're going to tax these people whenever they transfer an asset, how are you solving this? I don't get it. Either you're going to have to distort the base in such a way that incentivizes holding assets which you might exempt because you don't want to go through the trouble of valuation then, right? If you don't want to go through the trouble of evaluating the value of art or real estate or these things that are kind of hard to value because they don't have a clear market price. If you exempt those, now there's a big incentive for people to reallocate their spending to that stuff. And you probably don't want to do that. If you don't exempt them, then you just for one, because they are harder to value, there is still some incentive to do that because you can fight on that stuff more with the IRS and such. And then there's administrative waste in attempting to value those assets. And then you're just, at that point, increasing the overall burden, again, on investment and such. And especially in her case, specifically transferring assets. So you would just have like a big lock-in effect. And that would also just create a general distortion in the amount people choose to save and invest.
That we're going to have a strong enough IRS to be able to do annual taxation on these very complex interests, I think is really problematic. And there's going to be a great incentive for people to move their assets out of the easy to value stock market to the difficult to value partnership interest. And
I don't get how she avoids this problem. I don't get it.
That could impose a cost on all of us who have retirement and other savings that really depends on a robust stock market for our
True. How do you fix that?
own savings. And so I think there's a lot of problems with the wealth tax.
If we could get it done, let's say that our IRS was highly effective and our appraisal systems worked, do you think that it would be the right?
We don't have to watch as far. We might skip ahead of it. She just says, "Oh, in a perfect world, maybe
that it could be effective and that we could get the value and we could get the public to not recoil at the idea that you have to report every single thing you own to the government," which I think is another potential problem with the wealth tax. Sure, I think it would be great. I think it does.
Wow.
That is piling up and up. So we mentioned the deficit earlier and this unbelievable national debt that is piling up and up.
Huge problem.
And it seems as though there's sort of this divide between the left and the right, where the right says that the problem is how much money we spend, I would also add that the right is actually the one that is more responsible for the irresponsible fiscal spending, but that's maybe another conversation. But that's the argument on the right. The government, that's their area of focus. The government's spending too much. Let's get Doge and let's make sure that we see less wasteful spending. And then on the left, it's that we're not taxing rich people enough. We're not generating enough tax revenue. And so that's the thing that we got to focus on. My question for you is, what is a bigger problem? Is it the spending or is it the tax revenue?
It's the tax revenue, without a doubt. It is, and I think that if you look at the numbers, as I say, from, let's say, 2024, those are the numbers I have in my book, right? The country took in $5 trillion from all sources, just under $5 trillion. That's income tax, payroll tax, corporate tax, estate and gift taxes, tariffs, everything, right? Fees at the national park. Total revenue just under $5 trillion. We spent $6.8 trillion. So we had a shortfall. We had to add to our national debt. We had to borrow to make that $1.8 trillion deficit to cover it, causing huge problems to have this growing debt. Meanwhile, at the same time, the richest 1% of Americans own $55 trillion. I say that that there are all sorts of ways that wealthiest 1%, not just the billionaires, are able to avoid taxes because they don't pay taxes on their most common sources of income, which is their investment gains and their inheritances. So
it's weird that she's using the 55 trillion number there and then immediately switching to income, because that 55 trillion is not their income. Not only is that not their taxable income as we have it now, it's not their income that could even conceivably be taxed. That is just their like paper wealth. If you try to tax even a substantial portion of that 55 trillion, the value of it would no longer be 55 trillion. And it would be really hard to even tax many of the like private businesses that exist or whatever, because they don't have the cash to pay those taxes if it's a privately held business, and that's where the majority of their wealth is from. So they're probably gonna have to sell the business. It's gonna lose a lot of its value that way. Doesn't make sense.
So the failure to bring them into the tax system.
And we talked about this earlier, but we already have a substantially progressive tax system, even according to essentially everyone's numbers, on the whole at least.
I find it hard to believe that we wouldn't have been able to easily cover that $1.8 trillion shortfall by taxing people that owned $55 trillion.
I've looked at some of the numbers in terms of tax revenue as a percentage.
You have to raise, that's per year, right? That we have that over $1 trillion shortfall. You have to raise that amount every year. Even if we're like, you're talking about taxing, even if we take the 55 trillion number at face value, 1/10th of their, 1/50th, I guess, never mind, of their income every year to do that. And like, that's pretty substantial, and considering that's not even their income, that's their wealth. This is a good chart by Jessica Riedel, I think is how you pronounce her last name, but she's talked a lot about this and the deficit and such. You can see the different types of taxes and how much it would raise and how much it would take to stabilize. This is just simply stabilizing debt to GDP at 100% by 2040. You see the things that raise the most, like raising payroll taxes, raising income taxes across the board. These are things that are like not substantially progressive. Impose a 20% VAT. This is not progressive on its own. You could design a system of rebates. This is, I guess, progressive, but not of the nature she's talking about. 50% income tax over 200K, 400K married. Bernie's wealth tax plan, that's not gonna even raise a substantial amount, like $2 trillion over the next 5-10 years. I don't know when this chart was made. Raise corporate taxes. That's not even doing a substantial amount here. I think in here too. Yeah, you can see much of the discrepancy between the US and European countries with regards to taxes is not within the like super progressive taxes. It's within the broader taxes on lower and middle income people, like for example, VATs. Also, this is just like a crazy thing to say.
To make a significant change.
I don't think that's the case at all. I mean, if we're talking about, when you start using a number like the GDP is enormous. So you can't really see the differences, right? I don't think
for the amount of taxes we raise is also enormous, considering it's like 18% of GDP. But the reason we want to compare to that usually is because kind of two reasons, but one, obviously cross-country comparisons are easier that way, and two, because it represents the size of the tax base, right? GDP is equal to income. It represents the size of the tax base, the things that you can conceivably tax in any given year.
Differences of raising 4.9 trillion and 7 trillion when you're talking about in relation to GDP.
That'd be like 2% of GDP.
A significant.
That's a meaningful tax increase.
I don't think that's what we're doing.
I think one thing we haven't talked about is what I would describe as the biggest tax cut in history in the U.S. and also the most elegant, and that is neutering the IRS.
It's a travesty, and it's a giveaway, and it is, I couldn't agree with you more.
What is it, $750 billion a year that goes the tax gap that goes uncollected?
I'm sure it's great.
I don't know where they get that number from. So I think that we should have a strong IRS, to be clear. I don't know where they get that number from, though. We were looking at this a bit earlier, too. So this is the same paper we were looking at earlier. $300 billion for the top quintile, the top 4 groups combined. They estimate 720 billion in total in this favor as a correction to the IRS's estimate, which they claim was overestimating the amount of avoidance from cryptocurrency. I have to read more into it, but I don't think certainly the top 1% are not saving that much.
Greater than that. So, I mean, we need to fix the tax code and we need to fix the IRS.
The next big change in our economy is likely to be AI. We're seeing these data centers go up all over the place.
The word.
We've discussed sort of in general terms about figuring out a way to tax this. Maybe you tax the data centers. What do you think is the right taxation approach to this?
It's called DBCFT again. Okay, equivalent to a sovereign wealth fund with equal shares in every company, essentially a passive investment.
Next big technology.
AI is really going to cause a problem for our tax system, if you think about it. And it's interesting. I was at a program the other day, actually one where Scott got an award, and leadership now. Somebody was speaking, an AI expert was speaking about, well, how AI might very well be disruptive, right? We're gonna replace a lot of workers with AI agents. And he said, well, the answer is going to have to be UBI, universal basic income. And I'm thinking, and who's paying for this universal basic income? Because in fact, when you look at our income tax system, right, 85% of the revenue comes from individuals and labor and payroll taxes. And so if we remove workers and we're going to have massive capital growth, we're going to have a lot fewer workers, we're going to really suffer in the amount of revenue that we're raising under our existing.
So like some of this is like plausible to me. Now I'm not an AI doubter or anything. Okay. I am a AI power user even. Okay. I'm a Claude mastermind. I got my Claude and Obsidian set up. Okay. But it's not clear to me that at least in the like medium term, the effect on employment is going to be huge. And to the extent there is a effect on employment, that even with our current tax system, because of the increase in productivity that the remaining workers would have, that wouldn't make up for any of the decreases in employment that you see, right? If you just had, like, let's say, 10% of workers were displaced, but, the other 90% of workers, they've seen a big productivity increase because of the AI tools that they have. Probably it's going to be hard for many AI agents to fully replace, to fully substitute, and for firms to easily substitute to AI agents for the foreseeable future. And then the, sort of elasticity there of labor is not clear exactly which direction that's always going to run, because you can imagine, like, people tell this story all the time about bank tellers and ATM. It's like ATMs did not really replace bank tellers, because even though ATMs made the cost of engaging in certain banking activities go down, and people just demanded more banking services and such, right? Like, so there's some amount of that effect that's going to be the case with AI, to the extent the cost of doing research falls. People might consume more research, and that might be enough to keep at least some amount of workers employed, even not all of them, right? But
system. So I think it's
we could just do again DBCFT, just tax cash flows, okay, and that's equivalent to a passive investment in every company, essentially, from the government's perspective. Because if you tax cash flows, you're only taxing kind of the supernormal returns. And then when companies take a loss, when they have negative cash flow, you give them a deduction, which they carry over to the next year. And if they're still around the next year, but and that's essentially equivalent to being an asset holder in the company, right? If you own stock, that would essentially be equivalent to the income you would get if you owned shares in a company. And DBCFT ideally in the real world, of course, there's always going to be exemptions. There's always going to be some political exemption for something, okay? But ideally, it would be just being equal tax across every company, and that way it would be equivalent to just a passive investment in every company. Of course, I'm sure if we were to actually do it, there'd be an exemption for food or something because we wouldn't want the price of food to go up, but, you know.
Serious problem. So one thing is that we need to address is by making sure that we are in fact taxing capital, because under our current system, we don't tax capital, and that's, of course, where all the gains are occurring. As opposed to taxing companies, I think that we're going to have to figure out.
Which, like, I can understand thinking why the gains from AI would go there, but it's not like the returns of capital have been higher than, like, the returns to labor. But for the time being, still plenty of return to labor to catch, okay? You can look at the labor share of income. It's, like, declining, but it's, like, not like there's nothing there. Still at we're above 70%. So
out how to do it. I don't have the particular answer to it, but we're gonna have to find a way of bringing this massive growing concentrations of wealth into our tax system as well, either under corporate taxes, business taxes, or special AI taxes.
The big problem in the political world is getting everyone to agree on this stuff. We can have the right answer, but if we can't get people to agree and get behind it, then doesn't matter, it doesn't work. So I'd love to get your thoughts on how we do that. What is the message? What is the argument that we can get everyone behind such that we do come up with the right solution and fix the problem?
I love your question. Thank you for that. The answer starts with educating the public. As you started your very first question, right? People are being told that the rich people are already paying taxes, and
like, I just we're not going to watch the full conclusion, but just to educate the public, okay? This girl is supposed to be an expert, okay? And, like, she's clearly, like, knowledgeable in this stuff or whatever. But I think it's fair to say people, when they watch this, are not going to come away with, like, a better understanding of this type of stuff in a sense that they understand. They actually have a more knowledgeable, truthful understanding of the subject than they did previously. I don't think it's going to happen to many people. I don't think she's properly informed people of the differing estimates of wealth and income inequality. I don't think she's properly informed people of how progressive the overall tax system is. I think she paints a very misleading picture about payroll taxes and how they distort things. I think she does not do a good job at explaining it's weird because the flaws she presented with the wealth tax, many of those same issues I think would apply to her tax. And I don't think he does a clear job of explaining at least the potential pitfalls there. The fact that when we talk about capital gains tax and equalizing the rates of income and such, we don't explain the sort of double taxation that would occur there. And we don't explain the issue that we say other people have. It's they get super wonky and bring up the Laffer curve as if that's, like, the substantial issue that people like really fight on. That's not what the wonks fight on, bro. That's not what the wonks fight on, okay? I think it's just, it's what I expect from these type of podcasts, but it's cringe, it's flop, okay, it's dishonest. Let's play Export Hold'em real quick. Sorry, not Export Hold'em. Pick 5 and Tradle real quick. Okay. No, you guys must be missing this from the streams. Semi-finished iron. I'm going to guess China, potentially Australia as well. Okay, China's number 4. I'm going to guess Australia, but I'm kind of doubting that. Yeah, okay, goddamn. I'm going to guess Germany. Okay, they're number 7. God, what could I don't really know what semi-finished iron is, if I'm being honest. Japan and South Korea are my next guesses, but then I'm out of guesses, and I feel like maybe the US is on there. Okay. I'm going to guess the US. It could be Korea. It could be... I really don't know what a country that makes semi-finished is. Semi-finished, to me, implies some amount of, like, capital intensity. And I would guess not many, like, poor countries do that because they would just produce the raw materials for the most part. Fuck. What number 25? Russia. Probably could have guessed that. Oman. I would never have guessed Oman. Brazil. Would never have guessed. And then we'll play Tradle. Okay, non-fillet frozen fish, 90 million. God damn it. It's some island in the Pacific, probably. Yep. And I'm not going to know which one it is. Marshall Islands. Samoa, American Samoa. Fuck, I don't know. This above Samoa? I really don't know. Fucking Christmas Island, bro. All the like saints are in the Caribbean. So it's gotta be. I don't know. These are all the Pacific Islands I know, bro. Whenever I play like the geography games where I have to click on every country, whenever I can recognize the countries when they're in the Caribbean or in the Pacific, but I just like randomly click. I don't know where I don't know where they are within there. I genuinely don't know. I might recognize the name when I see it, but I really don't know what it could be. East Timor. Not a country. Fuck. Pretty sure this is in the Caribbean. It's like the only island I can think of right now, though. The Cook Islands. Nope. Cayman Islands are also in the Caribbean, right? Coco, I don't know what this is, but it's probably not. It's probably not this, but I'm gonna guess it. Yeah. But bro, don't even recognize the name. Don't even recognize the name. I'll have the like sources linked down below. As well as like my GitHub stuff. Like, subscribe, share all that stuff. Hopefully streaming again soon. The Wi-Fi's been better today, but I have no confidence that that'll stay. But we'll see. I'll be making a video about housing. I think going over more for unions housing thing, either tomorrow or the day after or something. So stick around, like, subscribe, share for that, and I'll see y'all next time.